Hi, welcome back. In this video, we will learn about how capital expenditure impacts the three financial statements as well as the impact of depreciation as time passes by. Capital expenditures represent investment in long-term assets that are expected to provide benefits for a longer period of time, that is more than a year. Initial impact of capital expenditure will remain between balance sheet and cash flow statement. In balance sheet, capital expenditures are recorded as assets on the balance sheet. These assets are capitalized and depreciated over the useful life, resulting in a decrease in the asset value over time. In cash flow statement, capital expenditures are typically financed through cash or debt or equity combination. The cash outflow for the capital expenditure is reflected in the investing activities. Now, to reflect what I have tried to explain is we will be linking the asset, that is the balance sheet, to cash flow in a different manner. Previously, what we observed that the working capital line items, meaning the day-to-day operations or the expenses or revenue matters that are impacting in our daily life as a business operation, is represented as changes in cash flow statement. However, in capital expenditure, we will be linking our long-term asset from cash flow statement to balance sheet. That is assuming, let's say if I am investing 200 to buy a new property, plant or equipment or a new long-term asset, make sure we are using the correct sign. Capital expenditure is an outflow, so we'll be using 200 as a minus sign, and similarly I'll be applying paste special to make sure our formatting is correct, and the number blue as I am putting an assumption over here. So we'll be doing custom formatting of 0. I'll be explaining custom formatting in the future, but just for your understanding, this is how we can formatize the number. As a next step, we can also benchmark capital expenditure against our revenue just to understand to what extent we are investing into long-term assets as part of our revenue, that is from our revenue. So on an average, we are investing 9% of our revenue in capital expenditure. Moving on, we will be bringing the asset from cash flow statement, that is PP and E or long-term asset from cash flow statement. Please note that I have a minus sign here because spending on cash flow statement and I'm bringing that asset on balance sheet. So this is how capitalization impacts our balance sheet. And as you can see, our total assets has grown by 200, that is to 920 from 720. We will be linking cash from investing. As you can see, the balance sheet balances. In income statement, capital expenditures do not immediately impact the numbers. Instead, the cost of asset is depreciated over its useful life. That results into depreciation expense on the statement. Currently in T1, there will be no impact of capital expenditure or depreciation in income statement as we have just bought this equipment, and as time passes by, that is in T2, there will be depreciation impact on our income statement. I'll be linking the T2 right now to understand the impact of depreciation. First, I'll make sure the other factors remain constant. So as of now, I'll be just changing and tweaking assumptions at a base level. That depreciation is linked to cash flow statement as non-cash expenses, meaning this is not a real cash outflow right now happening in front of our eyes. Indirectly, we have not spent an actual cash, so that's why it will be added back in cash flow from operations. In balance sheet, the depreciation will reduce our carrying amount of the asset, and the original cost of asset will be reduced by the depreciated amount. Incorporating the calculation of depreciation on our income statement, assuming the useful life of our asset is approximately 5 years, we make sure on income statement this is an expense, and I will give them base special over, and this expense is impacting our EBIT and net to our PAT. Our net income is linked over here, we'll be adding back depreciation. Make sure to change the sign to adjust the formula as well. And as we can see, there is a mismatch of 40, mainly because we need to remove the impact of depreciation. I'm using a minus sign over here, and this is how balance sheet balances. Applying the concept of capital expenditure we learn in practical life can help a lot in understanding how it impacts in our daily life. Analyzing the restaurant business, such as Domino's or McDonald's, it is evident that capital expenditure attracts more revenue growth. As McDonald's or Domino's spend on expanding new stores or identifying new territories to establish their businesses, it brings expansion in terms of customer base, diversification of offerings, brand recognition, economies of scale, and franchising opportunities. Businesses need to make sure that the expansion or capital expenditure should be carefully planned and executed to ensure sustainable growth. Thank you for watching. I hope it was a great learning.